What up, investors? I'm Phan and welcome to Phanance, where I keep you plugged into the market. This week, we're talking about China, the Fed, and FAANG stocks. So let's do this. All right, so first things first, let's dive right in and see what happened in the markets this past week. Here's the 5-day chart showing the three major indices, the S&P, the Dow, and the NASDAQ. You can see that the markets dipped early in the week, but then bounced back with a vengeance by Friday. Okay, so let's go back to the sell-off at the beginning of the week. This was in large part due to Caterpillar's disappointing results. Caterpillar? You mean like the bug that turns into a butterfly? Not quite. I mean the maker of big, heavy-duty equipment. The kind you would probably see on a construction site, like a bulldozer, an excavator, or a truck. Caterpillar has long been considered what investors call a bellwether stock. A bellwether stock is a big giant company that investors believe serves as a leading indicator for the economy. So the thinking goes, if a bellwether company reports good, strong results, then that bodes well for the overall economy. On the flip side, if the results are bad, watch out. And so when Caterpillar announced that the results don't look so bright because their business in China is weakening, and the folks over in China aren't buying as many heavy-duty equipment, that freaked investors out, and the market fell. All right, so the week starts off rough, but then boom, the market pops and it's off to the races. What gives? What gives is the Fed. The Fed is short for the Federal Reserve, and it's the central bank of the US. Think of it as the big mama of US banks. And just like Big Mama at home keeps everyone in check, the Federal Reserve keeps an eye on the US banks and the overall economy. And one of the ways the Fed manages the economy is by influencing interest rates. So to give you some context, over the past few months, investors have been really worried that the Fed was raising interest rates too fast. You see, when interest rates get too high, it discourages people from making purchases, like a car or a home, which are things that often require someone to go out and get a loan. And if you raise the interest rate, it makes it more expensive to make that purchase. That's why over the past few months, investors have been saying to the Fed, yo, Fed, chill. Stop raising interest rates, will ya? Prior to this week, the Fed had largely ignored this request. But then on Wednesday, they changed their minds and surprised investors. And they basically said, yo, we hear you. We're going to slow our roll. And they essentially said that they're going to stop raising interest rates for now and do what it takes to get the economy back on track. And because of this statement, the market took off like a rocket. Investors refer to the Fed's change in mindset as dovish. Oh, like the soap? Nah, like the bird. The terms dove and hawk refers to how someone feels about interest rates. A hawk is someone who likes to raise interest rates, while a dove wants to lower interest rates. Because the Fed shifted from saying it plans to continue to raise rates to, yo, we're going to hit pause for a second, this reflects a dovish stance. The market loved it and was like, hey. Okay, last major event of the week, FAANG results. And when I say FAANG, I don't mean these. FAANG stands for Facebook, Amazon, Apple, Netflix, and Google. And these big technology stocks have been killing it for years. Here's the 5-year chart. Check out these impressive gains. And because of this outstanding performance, they've earned a special distinction and acronym, the FAANG stocks. Anyway, 2 of these FAANG stocks, Facebook and Apple, reported better than expected results. And this gave the market a little extra boost. Okay, so let's wrap it up. How do we make sense of all this? Well, my personal take is that the Fed's comments are definitely good for the stock market. And the market, I believe, is going to continue to climb. At the same time, I still believe it's a time to be cautious. So I would let your investments ride, but I wouldn't be going out and buying more stock hand over fist. All right. Hope you enjoyed this week's episode. If so, hit that like button. And if you have some investment thoughts of your own, I'd love to hear them. Leave me a comment. And then be sure to tap that subscribe button and stay plugged into the markets with me. Until next week, stay up and invest wisely.
Now that all my dreams are manifesting, faces even big, see when it resting.